Let's turn to Kenya now. The finance minister in East Africa's largest economy says macroeconomic conditions are not right to lower tax rates on income and consumption taxes. And that's despite a now 3-year-old policy paper from that ministry promising to do just that. Published in October 2023, Kenya's medium-term revenue strategy aims to, among a whole host of other things, lower the top rate of corporate income tax from 30% to 25%, and then to review and rationalize a whole host of tax exemptions, and even review the top rate of value-added tax. That's at a rate of 16% right now. 3 years later, most of these measures have not been implemented. But Kenya, remember, has a long track record of setting ambitious tax revenue targets and then not meeting them. In the 12 months to June, for example, the Finance Ministry had set a tax revenue target of 2.917 trillion shillings. That's roughly $22.6 billion. Actual collections over the period were nearly $3.8 billion lower. Missed revenue targets are a chronic problem in the East African economy. Parliament's Budget Office described past tax targets as unattainable. In November, the World Bank said revenue underperformance is, quote, consistent with delayed recovery in employment, declining wages and a struggling private sector. That, however, is not a position that the Kenyan finance minister agrees with.
Again, to go back to the Safaricom dividend backed loan, the argument that is being made here is, given how A, litigious Kenyan society is, B, the lack of trust in government that has been demonstrated, not just this year with the finance bill protests, last year as well, in that sort of environment.
This year there was no finance bill protest.
Well, there were protests of some sort.
Not on the finance bill. Rama, let's get that correct. The protest that was this year was on Sabasaba and commemoration of last year. Nothing to do with the finance bill.
An argument still came up again and again about government spending, right, and government taxation, because between now and last year, not much really changed in tax policy.
There's a lot that have changed. Rama, I realize you're not been following Kenya. I made a promise to Kenyans that there were not going to be any tax increases.
Any tax increases is one thing. But the argument that has been made is that, look, this government came in, taxes shot up, right? We had new higher tax rates, personal rates of income tax. We also had new deductions and so on and so forth. Yeah. So the argument will be, hang on, people are looking at their pay slips and they're saying, I have less money in my pocket. That has not changed. So for them, change would not be saying, well, we're not changing the status quo. Change would be, we're putting more cash back in your pocket.
But you are forgetting that we have also given reliefs to the same Kenyans. And we did it with the Tax Laws Amendment Law of 2024, December, which was assented to on 27th. One of the things that we gave a lot of reliefs on the contributions to the health insurance beyond what used to be, even before the new government came into office. We have given also the housing levy, something that Kenyans were crying about, and we responded. We have exempted pension benefits from taxation. That's a loss of revenue to the government, and it's a benefit to Kenyans.
But the counter argument anyone would make is, yeah, but we knew from the start when these deductions are being designed, right? If we're not giving these reliefs, if we're not building that into the design from this to start with, I mean, there would always be concerns and problems around that. I mean, that was easily foreseeable.
You see, Rama, I'm not denying that there are no concerns. Kenyans are rightly concerned, not only on taxes, but how taxes are used. What a good government does is to respond. There are things that we have done which we were not even asked for, but they are beneficial to the government. There are reliefs that we gave to Kenyans in terms of even meal allowance and etc. We gave it to private sector, which used not to enjoy it before. It was only the public sector. We gave reliefs on pension, which used not to be the case. And today, if you are retiring from public service, you get your pension 100%. They used to lose almost 30%. And that is beneficial to those who are retiring from the public service because you need that money. It is not just the lump sum payment, but even monthly pension. So there are a lot of things that we have also done from December last year, and I can account for that. But again, that does not mean we have reached a level where Kenyans are comfortable. We continuously continue to work around even lowering the taxes. And I mentioned this, that the moment we see that our tax efficiency has reached the optimal level, then we are going to move towards reducing the tax.
And I know people will watch this and ask, when? What would be the number that says our tax efficiency as measured by these metrics, we're now comfortable with this specific number in terms of, say, tax collections relative to the size of the economy, we're creating more formal sector jobs.
To that?
By all means.
The moment we start meeting our tax targets, then we know we have efficiency level at 100. At a percentage, then now we can move towards dealing with a reduction of the tax rate. You see, we assess the economy, and we know the capacity of this economy. So once we determine that this is our target for revenue collection, then if it is not met, we know our tax efficiency has still challenges.
The headline tax target number is something that the Kenyan state has not met, at least for the last 5 years that I can recall. Last year's figure, the target was around 2.9 trillion. We didn't hit that. And every single year, we have these arguments that come up between Finance Ministry, World Bank. Tax target is set too high. We don't meet it at the end of the fiscal year. So it's a bit of a moving target, isn't it? Because if we say, well,
it is not. Actually, last year's projection was initially 2.9, but it came down to about 2.76. I will tell you today, the revenue target that we have put for this year, in my view, was very realistic. The challenges we've had with meeting the targets is some of the disruptions that we had in our economy from June, July, again, started hitting us. The moment you have disruptions in the economy in terms of protests, it affects businesses, and that affects revenue collection. Look at our non-tax revenue. We are meeting the targets already. Even on ordinary taxes, we have started working on how to make our tax revenue projections realistic. And we reduced the earlier projection for ordinary taxes for this year was over 3 trillion. We reduced that to the current, which is about 2.7 trillion, even below what was in last year's projection. So if we consistently maintain that trajectory where we put realistic tax revenue projections and we hit it, obviously we will be at a point we are saying we have broadened the tax base in a way that now we are meeting our targets. We can now go and have a relief on Kenyans further. But I would be irresponsible as a CS National Treasury to just play populist and start saying we are going to cut corporation tax from 30% to say 20% or 25%. We are going to reduce pay as you earn before I think about the efficiency in tax collection and all that.